the incentive is provided over 10 years. There are two participants in providing the incentives. The first is the Commonwealth Government, who set the scheme up, but they partner with each of the state or territory governments. There are two different ways it's provided. The Commonwealth Government provides an indexed incentive for 10 years. So it's currently at $6,855 per dwelling per year. Now that's provided as a refundable tax offset. Now there's a bit in all that. The first thing is a refundable tax offset is different than a tax deduction that you would be used to from a normal property investment situation where you've got a depreciation and interest and the like. This is a tax offset, so it's taking off the tax. It's not taking off your income. So it's much more valuable, and it's refundable, which means that if you're someone who's, for example, might have a property investment portfolio and you've actually negative geared down to the point where your tax, where you pay no tax, in this situation, you would actually get a payment back from the government. So it's not just a figure that carries on to the next financial year. You actually get a tax refund check. So it's a very valuable type of incentive that the government's provided, and it will be indexed on the CPI every year for the next 10 years. And so you basically put that in with your tax return at the end of the financial year. The other incentive is a tax-free payment from the state government. This year, $2,285 per dwelling. Now, so that's very valuable. That's just basically the taxman doesn't have to worry about that. You just get that money tax-free. That gets paid to you at the end of the September quarter with your in October with your rental payment. Again, that's indexed. So it's very they're both very valuable sorts of incentives because there's no tax associated with them.
Yeah. Now, Paul, while you're talking about this, do you want to cover off just a little bit? A question may come up later, but just about Section 221D and what we understand where we're at, or where the government's at with Section 221D with NRAS.
Yeah, sure. So what happens is, because this is paid on an annual basis, and the cash flows we've shown take that out across on a 52-week period, you've got an issue there that in that first period of time, before you get the incentives, that theoretically you have to fund that cash flow for that first period of time until you get the incentives to come through. However, the government has a well used administrative form that you put in, which is Section 221D. I think it's actually these days it's called tax variation form. And effectively what you do is that you say to the tax office, we're anticipating that our tax will be lower this year because of the fact that we are getting this, in this case, an incentive payment from the government, and therefore we want to get your approval for our employer to take less money out of our tax on an ongoing basis. And they'll provide that on a person-by-person basis. They provide that approval, and that means effectively what you get is you get the incentive each week based upon the fact that you're allowing for the incentive to come in at the end of the financial year. The other way that we recommend that you can go is when you actually get your loan. Most people get a loan on the property, plus they borrow some money perhaps against their own home or another investment property. If you actually take out a loan with about a sort of $10,000 buffer in it, that means that you can fund that first year potentially out of borrowings if the 221D option doesn't fit.
Yeah.
The other thing I just wanted to say before I conclude on that, Greg, is that it's worth noting that the incentive is $1 per dwelling. So there is some incentive here that a lower priced property is in a sense better for you because you're giving up less in terms of rental, because you're giving away a percentage in rental, but you're getting a fixed dollar amount in the incentive. So in simplistic terms, it's better to get $300,000 properties than it is to get 600, because of 300 you get two incentives rather than one.
Thanks, Paul. we mentioned before that we're looking at a projection of $109,228 tax-free. That's indexed at the rent CPI. I just keep repeating that, so it's not the basket of CPIs, which have been running at 2.9. It's running at 3.9, and that's carried out from 2010 to 2019. Obviously, the scheme starts when you get a tenant, and it runs 10 years out from there. So, coming up May 1st this year, in a few months, the scheme will be increased again, somewhere between 4 and 7%, and then we'll be able to provide new figures based on the new grant for next year, which will obviously be 4 or 7% higher than the 9,140 we've got at the moment, then project that out for another 10. So that's just giving you a very conservative look. We've had the last 2 years, we've had an average of about 6.5%, 7% per annum. One year was 5-ish and the other was 8-ish. And this year looks like being 5 or 6 again. Our projection is based on 3.9, taking a really conservative approach on everything we're presenting here, on the rent indexation, on the capital growth, all of that. Always, as you would yourselves, take a really conservative approach. Thanks, Ruby.
I'll just add to that, Greg, or will actually just to clarify what you said there about when the payments start, because there has been a bit of confusion there. It's not on settlement, and it's not from the start of the program. It's from the date that you get a tenant. So it'll be 10 years from the date that you get your tenant. I know you did mention it. I just thought I'd touch on it again. Thank you.
Just one thing. I'm sorry. When Paul was talking about the that buffer, just remember that the buffer is required is not actually the 9,140. The only buffer you need is, compared to a normal investment, is the buffer of the 20% reduction you've given. So if it's a $300,000 property at 5% yield, you're going to be sacrificing $60 a week. So all you've got to do is fund that, which is about $3,120. That's if you have the full year to wait. So it's not a big buffer you have to come up with, but we just clarify that with you that obviously there is a period where you're going to be 20% less on your rent until you get the payment from the government. You're going to have to fund that in some way. You want to run through this, Paul, please?
Yeah, this is just basically taking a year-by-year look at what we provided on the previous slide. So the red bars there are showing what the actual incentive paid by the government, this is the combined federal and state incentive, what the actual amounts were in 08, 09 and 2010. We've then applied the 3.9% index factor in the green bars moving forward. So they've actually, I think we had 5.4 and about 8% in previous to indexation, so our 3.9 is very conservative. So you can see by the year 2019 that the incentive is going to be somewhere in the order of $13,000, which is a really attractive sort of incentive. Now, obviously, most of the people, or many of the people who are looking at NRAS at the moment, they might be in a position where their incentive won't start certainly until we've got the next year, next increase. So, we might be looking at 2020 or so, and then that'll be higher again because we keep on indexing. So our 109 to 188 is actually a conservative figure because people starting now will get something higher than that. We think. So,
thanks, Paul. Ruby. Okay, so it's in. If we keep coming back to the tax-free component, if you look at what you have to earn to get this sum of money over a 10-year period, obviously you've got to take your marginal tax rate, and if you're on that highest bracket, you're going to need to earn over $200,000 to get $109,228 tax-free, and even on the average marginal tax rate of 31.5, you'd have to earn over $150,000 over the next 10 years to earn, either through running your own business or through wages, this tax-free payment the governments are making to you. So just another graph to illustrate how powerful this is. Thanks, Ruby. So part of the criteria, we talked earlier about it's rented at 20% below market rent. Now, really interesting, those of you who have invested before, this is market rent, not a valuation that would be provided to a bank, and the valuer would be involved in years 1, 4, and 7 to check that the CPI is working correctly, the CPI adjustments are working correctly. So it's a valuation that's going to be done and coordinated by the approved participant and the managing agent of the property. And the thing to note there is that valuation is not being ordered by an institution. It's going to be true market rent. And as most of us know, on occasions, valuers will mark rent down slightly from what we really, in some cases, even while we've got a tenant in there paying a figure, the valuer will still mark it down a little bit. This won't be the case with NRAS. It'll be a market appraisal. And it's to be rented to eligible low and moderate income households with, and shortly Paul will run you through a graph of what those incomes are. Some of them are, for families, quite substantial incomes. It's not meant for the unemployed or people who are on some sort of benefit. It is for people who are employed but earning lower to middle income incomes. And they must be new dwellings in selected postcodes. We spoke earlier about the state government's getting to choose which postcodes. Obviously, they do their due diligence and research to make sure that they're not putting new dwellings into an area where it's not required. They're going to do a lot of work to make sure that the dwellings go into the postcodes where they want new dwellings for rent. So run us through this little graph, Paul, this little table.
Okay. The criteria of the government is that the tenants that tenant the houses and get the 20% benefit have to fit in within particular eligibility criteria, income eligibility criteria. And the table here shows you that income eligibility criteria depends on the type of household that's actually that's renting the property. Now, this is not all of the different types. This is just a selection of what's available. And what this shows is that an entry-level income and an upper-level income. So effectively, what happens is when they rent the property, they need to have an income below the entry-level income, but they're allowed to continue to be part of the scheme until as long as their income doesn't go above the upper level. So in this case, if you had a couple with a child, if they earn less than $72,653, they'd be able to participate in the scheme and get the NRAS incentive would be paid, and they get the 20% lower rental, and their income could increase until it got to $90,817. Now, what happens though is that this is again indexed as well. So over a period of time, as people's income is increasing, so too is the upper level of the income. Now, I think it's really important here to stress that the average household income for private rental tenants is around about, last ABS stats we had, is around $74,000. So if you look at that against the entry level incomes here, we're really talking about normal private rental tenants getting access to this scheme. We're not talking about low income unemployed type people. We're talking about working families who are on lower incomes. So one of the first things that people sort of get panicky about is ghettos and housing commissions, buildings and all that sort of stuff. This is nothing like that at all. This is basically going to be a situation where you've got a new property that's part of generally a suburb, dotted through the suburb, new property. You've got a standard sort of family that's going to go into a household that's going to go in there, and in fact you're going to get the choice of tenants because they're going to be seeing a 20% lower rental for their property that they're going to rent. So you're going to have people queuing up, basically wanting to get into a new level. So you're going to be in a much better position from a landlord point of view, with a better choice, standard sort of private rental tenant that's going in there.